Hey guys, welcome back to our YouTube channel, and guys, I hope you are absolutely having a great start to 2020. We thought we would kick this year off with an absolute epic episode of saying 4 stocks that you should be watching for 2020. Me and Elliot are going to be discussing these in a second, but guys, don't forget to thumbs up, comment and subscribe if you're really enjoying this content. First of all, we're just going to do one each, and we're going to start off with defensive stocks that we want to focus on. So my first one that I'm going to be focused on is Diageo. So Diageo has been moving very strong over the past 3 or 4 years. It is a defensive stock. It's well known for it. For those that don't know, Diageo is a beverages and alcoholic company with loads of subsidiaries underneath it. It's well diversified as a company and is heavily defensive. For those that don't know what a defensive stock is, a defensive stock is a stock that even in hard times when the markets are doing bad, or for example yourself, if you was unemployed, you would turn to. So for example, necessities. So at the end of the day, you'd still need to brush your teeth with toothpaste, you'd still need toilet roll and so on and so forth, you'd still need electricity, you'd still need gas, and guess what? You'd probably turn to alcohol, being an alcoholic beverage, and also tobacco, so tobacco stocks. So they're kind of a few of the stocks that you'd look at in the defensive industry. So defensive is what Diageo falls under. It's been making good kind of headway in its performance. As you can see on the charts here, it's been moving up. And then ever since July, we've had a sell-off and a pullback. Now, with a defensive stock like this, the likelihood of a heavy sell-off is kind of unlikely unless we hit a massive kind of peak in confidence in the economy and so on and so forth. Obviously, we've now got our conservative majority, but nonetheless, the company is still doing good. It still has good dividends. Its dividend payout is currently sat at around 2.1% on dividends. So for a stock that doesn't really take too much of a tumble, you're getting your 2% dividends, and you're also getting the gains that you're going to be able to see here on Diageo. So we've had the pullback going through December, and it's now time to look to buy. And my arrows here that I'm showing you is producing roughly a 13 to 14% potential rally up to the highs of where the market is. So that's my first stock to watch, and it's a stock that I'm going to be buying into, and that's Diageo. So if you want to have a look into that, it's one to keep an eye out for. Over to you, El.
Cool. Yeah, so sticking on the defensive plays, that stock is Unilever. So this is a huge FTSE 100 company, current market cap of around 120 billion. You may not know Unilever as Unilever, but you'll know some of their brands. So they're like household staples, consumer staples. So you've got things like Marmite, Knorr, Dove. They've got hundreds of brands. But yeah, massive company. And if we look at the charts from a technical standpoint, we've had a bit of a pullback from all-time high set in around September. So it rallied from last March around the 4,000p level up to 5,300. So that's over about a 6-month period, that's a 30% rise, and in a defensive stock that's quite a considerable rally. So naturally we've seen a bit of a pullback. We're currently at 4,400. So my area of interest is pretty much between the original 4,000 level, sort of around this sort of zone it's approaching now, so between 4,000 and 4,300. So last few days they actually made an announcement that Unilever were going to miss their expectations, so their profits, so their sales were going to be on the lower end of their expectations, which saw a bit of a 5% fall in the share price. However, longer term, I don't think this is going to have a massive impact, and if anything, this gives us a better price to get in at, a better buying opportunity. So yeah, just going to keep a close eye on this one, back towards that 4,200 level. Any sort of form of consolidation, wait for that buy-in to come back in, and then yeah, we'll be looking to buy that and sort of ride that back up towards the 5,000p, 5,300 previous high level. So yeah, that's my defensive stock.
A couple more things that I'll add to Diageo, because Elliot's kind of went really in detail there. So I thought, you know, I didn't even mention the market cap, so it makes me look bad. So 73.9 billion is the market cap for Diageo. Now, for those guys that don't know the brands that are under Diageo, you have stuff like Ciroc, Johnny Walker, Black Label, Bailey's, Smirnoff, Captain Morgan, Guinness, loads of brands along those lines. So I'm pretty sure some of you guys know those, and hence the size of them. So some of the parts that I like about Diageo, why I'm buying it, is not only because of the pullback. So we have had a good sell-off of the highs, like I mentioned, of about 13.6, call it 14% of a drop. But also if we look at intrinsic value as well on the stock of Diageo and doing the calculations, current price is sat at £31.56. It is currently undervalued as well by 10%, so the actual value is around £35. So that when we're looking at that, we've got a 10% in intrinsic value, as well as seeing the potential of 13% rally on Diageo as well. So that's a bit more of a summary of a stock of why I like it, why we should watch it. We both decided to then go ahead and look at two growth stocks, two stocks that aren't defensive focused, that are more consumer driven, and are stocks that we're keeping a close eye on just because of the sheer amount of growth they've got as a potential move to the upside.
So the growth stock I'm going to be talking you through is a company called GB Group. So these guys, they're a FTSE AIM company, so smaller company, not listed on the main market, they're listed on the AIM market. If you want to know more about that, I'm sure we've got videos on that. If not, let us know and we can do a video on the difference between the AIM market and the main sort of LSE listing. So yeah, GB Group, their market cap's about 1.5 billion, so a lot smaller than compared to like Unilever and the Diageo that Sam and I were just talking about. But this is good because this gives us a lot more room for growth. They're an ID verification company, so they can verify around 4 billion people. And these ID checks, so the customer will send in their ID, and within, you know, a few seconds, these people their ID can be verified. So this is something that's become a lot more prominent in the last few years, and something that's developed quite quickly. There's new ways to verify people. They're looking into, you know, more fingerprint IDs, eye recognition. So really cool, interesting company. If we look at the share price, got it up here on my screen. I mean, they're at all-time highs. So we would be waiting for a pullback. But this doesn't mean it's not still an attractive proposition. You know, their share price is rallying for a reason. You know, they've got year-on-year growth. They're growing their profit every year for the past 5 years. But yeah, looking at the share price, so they've broken through around 636p. If we look over the last year, 2 years, it's come up to that level, tested it, come back down, tested it again, tested it 3 or 4 times, and then since it's broken through that, it's pretty much been on a straight upward rally from there up to 770. So yeah, like I say, we're at all-time highs. Ideally, I'll be looking for a pullback back maybe towards the 700, just because that's sort of like a psychological level, and then looking to buy that and sort of hold this over the longer term. So, you know, with our stocks, some of our stocks we can look to hold 5-10 years, especially the smaller companies that, you know, have that bigger room for growth. We're not just going to be in and out of that, because we want to see that longer term value, that longer term growth, to compound sort of our gains. And we can do that by, over that time period, looking to add to that position on pullbacks. So yeah, that's my growth stock.
So I'm going to be talking about, on my growth stock is Future. As we can tell by the name, it's pretty cool in itself. These guys are unbelievable in the amount of subsidiaries that they own. So to give you a brief, quick rundown of exactly what they are, they publish content, in short. They publish content for technology, gaming and entertainment, music, creative and photography, home interests, education, television, hobbies, knowledge, B2B sectors, things like that. And it's literally all the way across the United States and the UK. 1.4 billion is their market cap. These guys have literally been on a rocket ship. Their share price from 2017 to now has rallied over 1,100%. So that means 2 years ago, if you bought £1,000 worth of these shares, 2 years later, you'd be sat at over £11,000 in gains, which is awesome. So if you think about that, that's an absolute insane amount of gain. So a lot of people are probably wondering, has it still got a lot more movement? Well, these guys just keep on acquiring and buying new publishers and new content providers and adding to their portfolio. So I definitely think it has got a lot of upside that we can see within this stock. Now, believe it or not, getting pullbacks on this is ridiculously hard. I mean, I say ridiculously hard. A pullback is about 17%, but that kind of does this in a week sometimes in regards to its performance, and sometimes over 3 or 4 days. So it's a really powerful, interesting stock at the moment that a lot of people are focusing on. So things I like about this from a fundamentals point of view is that it's very strong and healthy from a cash flow point of view. So I'll break that down a little bit further for you guys. So if we look at intrinsic value, so share price versus fair value. So when we're looking at this, it's currently undervalued by 20.8%. So that means that we're getting this at a discount currently, again, if we're basing this off of intrinsic value. So fair value at the moment, they're saying is £17.79, and it's currently at £14. So room there for a 20% gain on your share price. It doesn't pay much dividends at all, 0.07%, but that's to be expected, seeing as it's a heavy growth stock and one that just keeps on literally rocketing. Let's have a quick look at its earnings as well. So I always like to look at debt, their debt to equity ratio, to see exactly how they're positioned. And at the moment, they're sat at 213 million in their equity value, and the debt level is sat at 46 million. So in regards to the two valuations, it's literally 5 times more. So the debt to equity ratio is 22%, which is considered very satisfactory in regards to that. So this stock is one to watch for the new year. It's something that I think is going to be going a lot further. And to be honest with you, it's already hit nearly 1,600, which is what we're talking about. The valuation these guys are saying was 1,700. So you know, it's easily within in the near term sight to be able to see that. I wouldn't be surprised if that was hit by the end of February, or if not March, you know, in the first quarter of 2020. That's all 4 stocks that we're looking at. So in total, from me, it's Diageo and Future, and from Elliot, it's Unilever and GB Group. So guys, check the stocks out. Let us know what you think in the comments below. And don't forget to thumbs up, comment and subscribe, and we'll see you in the next video.